Welcome to the 2015 Fall FE Review Session for Engineering Economy. I'm your host, Andrew Nichols. Everybody get a hand up. So the reference handbook has mostly tables and charts related to the P given, A, all those factors that we're going to go through here in a few seconds. And that's probably the majority of the questions that you will be asked related to the FE review. And they should be almost the easiest questions that you have on the FE because these calculations are so easy. So you're going to get 4 to 6 questions on these 4 topics. Some of them I'm going to go into more detail. So the discounted cash flow. So I'm sure you all painfully remember the cash flow diagrams where you have an initial cost or something, and then you have something happening a few years later. And if you have your timeline, and it always starts at year 0. So if it's something that's happening right now, that's a P. If it's something that's happening later, it's an F. If you have, starting at year 1 through whatever year N is, if you have an equal uniform payment that's happening every year, this is called an A, or an annualized payment. So that covers the F, the P, the A. The G is a gradient. So if you happen to have a payment that is increasing at a gradient, this would be a G, not a 6. G. So if we have cash flow diagrams like this, converting, so we can use these factors to convert the F and bring it back to year 0. We can bring the A back to year 0. So everything brought back to year 0 is a present worth. So this is year 0. If it's a future worth, it's whatever the last year is in the cash flow diagram, or an annual worth would be the equivalent spread out, an equivalent payment, equal payment spread out over the entire life of the cash flow diagram. So the symbols, you can look up these factors. So if we were trying to convert this F back to a P as is shown here, this table here is for converting. First one is 2F given a P, or 2P given an F. So in this case, if we're taking that F, trying to convert it back to a P, this would be the row that we use. So this symbol here corresponds to a lookup table. So you'd be looking for the column P given F, whatever the interest rate that's given, and N corresponds to the year in which that F occurs, or how many years in between where the F is and where you're trying to get it converted back to a P. If you're using the formula, you're going to plug in the interest rate and the N, the number of years, and then that's going to directly give you the factor. So if you use this equation and look it up in the table, it should give you the exact same answer. The main time you need to use the formula is if you have an interest rate that you don't have a table for. So the FE book gives you factor tables starting at 0.5% all the way up to 18%. You don't get every one in between. It kind of jumps around. So if they give you 0.25% as an interest rate, then you're going to have to use the formula to do your calculation. They also give you these definitions, the nomenclature and definitions related to the cash flows on page 130. And then the one equation they give you is this non-annual compounding. So this is for calculating I sub E, which is the annual effective interest rate, which we'll go through an example of that here in a minute. So the tables, again, you have each column corresponds to what you're trying to do. Is it a P that you're converting to an F, or vice versa? So let's look at some calculations. So if we have a one-time amount of $500 is invested at an annual interest rate of 8%, compounded annually, find its future worth at the end of 30 years. So we're going to have a timeline, again, that starts at 0 and goes all the way to 30. So the 500, what year does that occur? 0. And it's being invested, so should it be an up arrow or a down arrow? So since you're getting rid of it, it's kind of leaving your pocket. You're getting rid of it. So this would be a P equal to $500. So what are we trying to find? F in what year? So is it going to be an up or a down? So assuming we withdraw it and take it out of the bank and put it back in our pocket, we're trying to solve for F. And we have an interest rate of 8%. So we're trying to solve for F, and we need to multiply times what P is. And if we're going to use the lookup table, we're going to be finding F given P, so that's F slash P at 8%, and N is equal to 30. What are the odds that the previous slide is 8%? It is not. So we will then use the equation. So the equation is taking P and multiplying times 1 to plus or minus. 2012 was the last time, but I taught it from my first semester here for every semester until 2012.
1 plus I to the end.
So I needs to be in decimal format. So P in this case is 500.
$5,031.
So in 30 years at 8%, that will be worth 5,031. So whatever you calculated for this, if we had that lookup table at our disposal, that's the same thing that you would see in that lookup table for that value. So if you have a lookup table, that's definitely the way to go as opposed to typing in the equation because they get much more complex. So if you need to have $800 in savings at the end of 4 years and your savings account yields 5% annual interest, how much do you need to deposit today? So we have going from 0 to 4. So what do we know? We know F. So we need to be able to take out an F equal to 800. And so we're looking for what?
P.
In what year?
0.
So what does P equal? So we know we will now, since we don't have a lookup table,
1 plus I to the negative n. $658.
not even with it. I don't know, 5%, you can't hardly find that type of rate these days.
I mean, just to give up the 6, and maybe if you had a huge amount.
Maybe we weren't college students, you know?
Yeah.
Yeah, 658 right now, I can't give it up for 4 years, just to gain $142.
All right, so this one, the company borrows $100,000 today at 12% nominal annual interest, compounded monthly. Find the monthly payment of a 5-year loan. What's our total number of periods?
6.
Very good. So since the interest is being, so the number of periods does not always have to be years. It's just the number of compounding periods. And since we're compounding monthly, we're going to go from 0 to 60. So the company's borrowing $100,000 today. So our P is going to be $100,000. And then we're making payments. And so annualized payments always start in year 1, not in year 0. So it's going to start in year 1. We're trying to find what is that payment. What's our interest rate?
12%. What I want, 1%.
How'd you get that?
12% divided by 12 months.
Right. So our 12% is an annual interest rate. We need our periods, our compounding periods to correspond with our interest rate. So to go from an annual interest rate to a monthly interest rate, we're just going to divide that by 12. So that would be 1%. So the equation for this is a little more complicated. So to find A given P, so we're going to have A equals 100,000. I'm going to go ahead and plug the values in. Actually, we have a 1% table, don't we?
Yeah. That's nice.
What's the values?
.0222.
So was that 200 or 2,000? No. What's 100,000 times 0.02222?
2,220.
2,220. Just sounds high for some reason.
Better be making a lot of money off that investment.
Questions on that one?
Make sure I got the interest
Not too
rate
bad.
right.
You're only paying back 133,000.
What's that?
You're paying back 133,000.
Oh, interest?
Well, not
No,
it's just
Total.
33,000.
So 33,000 interest. Questions on that one? Present worth. A new sander, so this is a little more complicated, more arrows. So they are, I mean, obviously I guess they could give you a word problem and give you multiple choice that has different cash flow diagrams, so they could test your ability to draw the cash flow diagram. More than likely, they'll give you a cash flow diagram and tell you to calculate the present worth, the future worth, or the annual worth. But I can guarantee you they're not going to give you a cash flow diagram as simple as this one. It'll probably be something a little closer to example 4. So a new sander costs $3,600 and has an annual maintenance cost of $400. The salvage value after 7 years is $600. Assuming an annual interest rate of 10%, what is the present worth? So we have 7 years. So the 3,600, where does that go? Up or down?
Down. That's an expense.
Down because you're buying it. Where does the 400 go?
Down every year.
So starting in year 1, you have an A equal to 400, and the 600
It's going to be enough if you sell it.
in what year?
So,
So we want to figure out what is the present worth. So we're going to have to convert all of these to year 0. And we want to make sure we keep the signs consistent. So if it's a down, it's going to be a negative. So the 3,600, what do we have to do to that?
Nothing.
So nothing. So negative 3,600 minus the annualized, so 400. So we're looking for a P given an A. We don't have that table. We're going to have what is N equal to?
8. Annual interest rate, 10%.
No, what is N equal to for the annualized?
Oh, 6.
This is a G-rated recording. You got a microphone right there.
We're not using that microphone, are we?
It picks it up.
Really?
I don't know how loud it is.
Your breath, you cut that.
So for an A, it is the total number of payments. So how many payments are there in this A? 7. I never said that you were wrong. There was another wrong answer. I was looking for some confirmation. So to the 7th, minus 1 divided by 0.1. And then plus 600. So this is going to be finding a P given F, which is 1 plus 0.1 to the negative 7.
Negative 5240.
When in a few slides, I'm going to talk about benefit cost ratio, but I don't have a specific problem to go over. But if you were to calculate the benefit cost ratio of this problem, what would that calculation be?
Would be the negative 5240 divided by 3600.
Nope. So what are the, just looking at the cash flow diagram, what is the benefit?
600.
Do we have to do anything to it?
Surely we have to project some sort of profit off of this thing.
Well, so clearly the benefit cost ratio of this is going to be negative, right?
Yeah.
But if we're calculating it, I'm- well, so then you might add in, if you were doing it as a job, you might have some positive income to offset it. But just to go over the basic benefit cost calculation, Brandon, did you get something different for the 5240? Okay. So the benefit, the point is, in order to calculate benefit cost ratio, all of the benefits and the costs have to be in the same year. So you would still need to convert everything back to year 0. On top, you would have the 600 times 1.1 times negative 7, whatever that gives you. And then on the bottom, we don't care about the sign. Benefit cost ratio can't be negative. So it would be 3,600 plus 400 times whatever was in, whatever that value is in the brackets. And then this would give you the benefit cost ratio. And you're looking for it to be greater than 1 in order for a project to be justified. But the point I wanted to make is that it wouldn't just be 600 divided by 3,600 plus 400. You have to include those factors to move those back to typically year 0 in the present worth is the easiest place to convert it to. For those at home, indicating that's a different problem. All right, effective interest rate. The annual nominal interest rate on the unpaid portion of a contract is 17%. Find the effective annual interest rate if the interest is compounded quarterly. So with the variables we have here are R and M. So if you look back to the variable list of variables, R is the nominal annual interest rate. M is the number of compounding periods. And then we're trying to solve for I sub E. So in this case, our nominal interest rate, 0.17. What's our number of compounding periods? So since it's quarterly, it'd be 4. Which is 18%. So why didn't we do this calculation for the this problem? Why didn't we calculate an effective I sub E is still an annual effective interest rate. And we need the interest rate to correspond to the compounding period. So what we used in this calculation was actually just this portion. So R, so we took the nominal divided by the compounding periods. This R divided by M is what you would use in a problem if you're given the nominal interest rate and you have either quarterly compounding. So we wouldn't use this effective annual interest, this effective rate in one of those calculations. They're going to, if they want you to use this, they will ask you to calculate the effective annual interest rate. But if they're not asking for that and they're giving you an annual with a different compounding period, you just use the R divided by the M. Why did my writing disappear? That's weird. Actually, there it is. That's useful. For those of you at home, go back to the previous slide and read the red. There it is. It's really weird. All right, so it talks about break-even analysis. And it gives you, this is what it gives you in the FE review manual. It gives you a verbal description of break-even analysis. I'm not really sure what value this is because they don't, or what value this is to you during the exam. In engineering econ, you probably went over a couple of different types of break-even analysis at the beginning of the semester, not before you get into the present worst and all the cash flow diagrams. There was a plot that should have looked something like this, where you have total cost, and this is from a manufacturing standpoint. So if you have a total cost to manufacture some sprockets or widgets or something, you have the fixed cost of doing that. So that might be when I taught engineering econ, I always used the example of selling hot dogs out of a hot dog stand. So your fixed cost, if you would be purchasing your stand and your fryer or however your grill, however you're cooking them, and then the difference here would be the variable cost. So that would be dependent on the number of hot dogs that you're selling. So it's kind of your material, your buns and sauce and things like that. So the total cost to operate your business is going to be this line. Is that a funny example? So, ice cream. How about ice cream? Is that better? So you have your freezers, and your variable cost would be the milk and whatever you're making your ice cream with. And you've got your total cost here. But then if you're selling, you're going to, as you sell, you're going to have a profit curve that looks like, no, you're going to have a income curve that looks something like that. And so this point right here would be a break-even point. So that's when your revenue, that's probably the better word to use, not income, revenue. So when, as long as your revenue is above your total cost, so this is going to be your profitable area. But then when you get out here, that's another break-even point to where because your costs keep going up, but the revenue actually starts going down because of the price-demand relationship. But anyway, this, from a break-even point standpoint, these would be break-even points. Did you guys go through that in engineering econ?
It's been a little while.
Any of you have me for econ?
I had Pearson. And I took it.
Okay, 2012, that would have been 4 years ago. Okay.
I took it like 5 semesters ago.
I'm sure Dr. Pearson went through this, but it's early in the semester. I'm sure he still went through it because when I started teaching, I took his notes. The other type of break-even analysis is the payback period. And so if you have a set of, in a cash flow standpoint, a number of things that are happening, your payback period, you're basically solving for N. So the payback period would be the number of years in that cash flow diagram to where the costs would start exceeding the expenses. So in this case, you probably have a really large P, and so you have some sort of income that's occurring. So at what point will that income allow you to break even in the project? Again, that's a pretty complex calculation for them to have you go through, and so I would think this would be more of a conceptual question if they asked you one. So this is the slide on the benefit cost analysis. I already mentioned that. So the benefit cost, the one I just showed you, was looking for the benefit divided by the cost being greater than 1. If you do the benefit minus the cost, then you're just looking for the benefits to exceed, and so the decision point is if it's greater than 0. So in that case, you can have a negative value if your costs end up being higher. But the key here is making sure that you convert them all to the same time period, year 0, or if it's a future worth, all to the final year in the cash flow diagram, or an annual worth. Life cycle cost analysis, again, they give you this description of inflation, and they give you an equation for calculating an interest rate that's been adjusted for inflation. And the F here is the inflation rate. So you can use that equation, and I'm sure you can figure it out during the exam if they ask you for it, but you're basically just calculating a different. Once you calculate this D, that would become the interest rate that you use in the previous calculations, the cash flow calculations. Also part of life cycle cost analysis is depreciation. So this is something that you should have gone over in 221. So we have 3 types of depreciation: straight line depreciation, which if you have the number of years and the value of the item. So if it's a computer, a car, a piece of machinery, those are going to depreciate over time, and this is just from a tax standpoint. So the straight line depreciation, you're going to use this equation to calculate a uniform amount that depreciates every year. And so you're going to start off at whatever its initial worth was, and then by the time you fully depreciate it, you're going to be down to 0 at the end. So it looks like a straight line. The other one that declining balance might be one that you talked about in class, but they don't cover it on the exam, on the FE exam. The other one is the MACRS, the Modified Accelerated Cost Recovery System, which is what this table corresponds to. So you're going to be given in the problem enough information to determine what's the recovery period, and so you're only given a table for 3, 5, 7, and 10 years. And each row corresponds to the amount that's going to be depreciated for that particular year. So you can see most of these, the first 2 years is when the majority of the value of the machinery or whatever is getting depreciated. And then it kind of tails off as you go along. But if you sum each of these columns, what do they equal? So the sum of each of these columns is going to be 100, which means using this particular depreciation method, by the time you get to the last year in each of these, then you've fully depreciated the value. So if you had a computer that was in a three-year recovery period, basically after 4 years, this is saying that it's not going to be worth anything, which is about the case. I mean, a computer that's 4 years old is pretty much worth nothing. Whereas maybe a vehicle might be a 7-year recovery period or even a 10-year recovery period if it's a company vehicle. So this only applies to businesses, not to individuals. So let's look at these calculations. An asset is purchased for $100,000. The estimated life is 7 years, and the salvage value is $15,000. Assuming the item is depreciated via straight line method, find the book value of the asset at the end of 3 years. Okay, so this is a straight line. So looking back at the variables, which I don't include. Yes, so these variables still correspond to the earlier slide. So C, we're looking for D sub J. So this is the depreciation in each year. And it's, again, uniform across all 7 years that we're looking at. So D sub J is equal to C minus S sub N over N. C is the cost, the original cost of the asset, which in this case is $100,000. The salvage in this case is $15,000, and then we're dividing by 7 to get our annual depreciation amount. So what's 85,000 divided by 7? Not a nice number for some reason.
12,143.
So at the end of 7 years, this is not going to depreciate down to 0. It's going to depreciate to 15,000. So it's not going to take it all the way to 0. So we're going to go from a value of 100,000 down to a value of 15,000. We're specifically asked to find what is the value after 3 years. So the value, the book value, B sub V in year 3 is going to be equal to our initial cost minus 3 years worth of depreciation. So since this is a straight line, we can just take 3 times the 12,143, and that will give us the book value at the end of year 3.
63,571.
Right, clear? I got that written down. Good. This one, the same asset, 100,000, but it has a useful life of 10 years. Salvage value at the end of 10 years is estimated to be 10,000. Using the MACRS, find the book value of the asset at the end of year 3. So here it's a little bit more, well, you can set up a table if you want to. I think we can figure it out without the table. But the book value in year 3, so we still have the 100,000, and the total amount that will be depreciated by year 3 is equal to what? So if we go back to our table and look at the column corresponding to the 10-year recovery period, so we're looking over here, 10-year. So in year 3, we will have depreciated 42.4%. So we would have 10 plus 18 plus 14.4.
That's how much it's depreciated.
Yeah, so that's our total depreciation. So technically, let me add should be 100,000 minus that.
Are this supposed to be in decimals? Because it's like a,
You're gonna end up with 47,600.
How's that?
$57,600.
So notice this one is depreciating faster compared to the previous example. The other thing, so this 10,000 is unnecessary information because again, the MACRS, if you sum up each of those columns, by the time you get to the end of the recovery period, it's fully depreciated. So the MACRS method neglects any salvage value. So they could throw that in there to kind of throw you off. So any questions on that one?
So at that point, the salvage value is like what you're scrapping the car that was once $100,000.
Well, so this is the confusing part with the depreciation stuff. It is only for tax purposes. And I always use the example of a car. Just because on your taxes, so if a company owned a car of some sort and they wanted to get rid of it, well, if the book value of it is $5,000, but they can get somebody to pay $10,000 for it, the market value, what they can sell it for on the street, doesn't necessarily have any correlation whatsoever, and probably won't have a correlation to what the IRS needs to see in terms of a book value. So the last category is this uncertainty. Again, I have no idea what they're looking for, what types of question they could ask you, but they do give you this write-up on risk. So I guess maybe you can read what risk is as it relates to engineering econ and apply that to a problem somehow. But you're on your own from there. So this concludes the engineering economy review session for fall 2015. Have a good night and drive safely.
It's been real.